It's time for another Beacon Leaders Minute.
War on Britain and raised an army. Instead of raising taxes to pay for it, they borrowed $10 million in 1812. The next year, the war continued, and they needed to borrow even more. They needed to borrow $28.5 million. The following year, 1814, they had trouble raising money. They had taken out a number of loans, and in fact, to raise money, they had to have 3 members of Congress personally provide the money to fund the country. By the end of 1814, there was no more money in the bank, and the US had to make a payment in specie, that means gold, to repay one of its loans, a loan of $5 million. It didn't have the money. It couldn't borrow the money and effectively went bankrupt in 1814. Congress was forced to raise taxes significantly, and it took till 1837 to pay off the debt. During the 3 years of the war, the US spent $156 million, $128 million on the war. And in 1815, of a budget of approximately $50 million, somewhere around 15 million was going to be interest and principal payments. Today, the US faces a large budget deficit. We have a Congress that is insistent on cutting taxes, not closing the debt window. And we have debt to GDP of well over 100%. Ultimately, the financial markets will be the arbiter versus the Congress. That's the required legal disclaimer. I'm required to tell you the SEC considers everything I say advertising. You can decide for yourselves. Alea iacta est. Supposedly spoken by Julius Caesar in 49 BC as he crossed the Rubicon. The Latin translates to the die is cast. However, if you study history, Caesar actually spoke the Greek because it came out of a famous Greek play. And what it said is, we will cast the die, which is very different in meaning. One of the things in thinking about the United States is, we will cast the die. Biden administration cast the die in a way that ended up with high inflation under modern monetary theory, where we had classic pump priming with a Federal Reserve that monetized the debt. Federal Reserve's gone on a QT torrent to take some of the money it created out of the economy. However, the federal government continues to spend money and prime the economy. We look at the government budget today. 95% of all tax revenue goes to entitlements and interest. In other words, there's no tax revenue to pay for the actual functions of government, whether they're a justice system, whether they're a military, or whether they are doing basic research needed for the country. As a result, US debt to GDP stands at levels last seen during World War II. And for those of you who wonder about the US's credit rating, the classic answer is the US really should be a junk credit, not an A-rated sovereign. And in fact, if the US was not the country whose currency was used as the currency around the world, we would be a junk rated, below investment grade country. Now, one saving grace is that interest expense is not at levels last seen during the 90s relative to GDP. That was the last time we had a financial crisis where we had to deal with the budget deficit. I would point out that we are running massive deficits at a point where the federal investment to GDP is very low. And that breaks down really into two areas: the government spending too little on public infrastructure and spending too little on US defense. Go back to when we were in the Cold War with Russia, we spent more than twice as much relative to GDP than we did today. One of the ways the US has historically solved its debt problems, all the way back to the Revolutionary War, is inflation. In the Revolutionary War, the US Continental Congress issued something called, surprisingly, the Continental. There became a very famous saying after the war: not worth a Continental. Because the Congress issued so much of that paper, it became worthless. The US had a large inflation after the War of 1812, had a large inflation after the Spanish-American War, a large inflation after the Civil War, a large inflation after World War I, a large inflation after World War II, and a large inflation after the Vietnam War, all of which served to effectively wipe out large portions of government debt. That has traditionally been the modus operandi of the US, which is an effective default, but not a real default. Here is inflation since World War I. As you'll see from that chart, inflation tends to come in waves. And while we've had one wave, it is quite likely we will have another. And I also point out that taxes are relatively low historically and likely to rise over the next 5 years, regardless of what the Congress wants. And the other point is corporate tax receipts relative to the economy are relatively low. So when Congress raises taxes, it won't be just on individuals, it will be on corporations as well, because in order to have the political cover to raise taxes on individuals where the money is, it will have to raise taxes on corporations and taxes that actually bring money in. Federal Reserve has embarked on a loosening campaign where it lowers interest rates and starts to increase the money supply. The only issue you have is that inflation is structurally back to where it was pre-2008. And the financial markets have started to price all types of capital as if that is the future. In fact, that should be the future, because if you look at the last 60 years of inflation, inflation has an average of 2.8 to 2.9% over that period, with very few periods below 2%. So for the Federal Reserve to actually target 2% in its pronouncements, which by the way, it never did until the early 2000s, and that came from Janet Yellen, does not make sense, because that is not how the economy works. And even if you go before World War II, that is not how the economy worked either. So even though the government's talking about 2% inflation, it seems reasonable to think about 3% or higher inflation. And in such a world, you're going to have higher interest rates and higher capital costs across the board. Yield curve has started to normalize, indicating higher growth ahead, and the Federal Reserve has started to put money back into the economy. We note that the global manufacturing cycle has turned upward, and you can see it in the US ISM as well as the PMIs across the world. Let's talk about housing and autos here. Okay. We had put out a piece in 2011 talking about the bottom in the housing market. Last year, we put out a piece talking about an effective top in the housing market. And by top, we mean top in real prices, not necessarily in the number of homes that'll transact or the number of homes that'll be built. And why? Because of the major change in interest rates we see. And in a rising inflationary environment, unlike the period from 1981 to 2020, you will see interest rates rise over each economic cycle. Now, this is FHFA median sales price. As you can see, it's been declining, and that's in nominal terms. And that's because, as we all know, housing is very sensitive to mortgage rates. Every 1% change in the 30-year mortgage represents a 13% change in mortgage payments. And first-time home buyers or move-up buyers are typically the marginal buyer of homes and determine which direction prices move. Homeowner affordability is now at the lowest level since 2006. And existing home sales, as a result, have collapsed. Well, we expect a cyclical rise in existing home sales, partly due to declining rates near term. Longer term, they'll be under pressure because of rising rates, much as what happened in the 1970s. Here's the S&P Case-Shiller Home Price Index, but more interestingly, here it is deflated by the CPI. And as you can see, it has not made a new real high. We don't think it will. We think real home prices have peaked and are going to go nowhere for quite some time. We also think nominal home prices need to go sideways for a while because incomes need to catch up with interest rates. Interest rates went up about 3% or so or more for a mortgage. And that means that the cost of a mortgage went up 40% plus. So to buy the same amount of house, you need to spend 40% more on your mortgage payment, which basically priced a whole bunch of people out of the market. So incomes need to catch up, and that will take a certain amount of time before they do. Okay, and here's new single-family home sales, and they have held up mostly because the home builders have been subsidizing the interest costs for first-time home buyers. Permits have held up as well because of that. And private residential investment is, in real terms, near levels last seen at the peak in 2006. Now, you have to be a little careful in looking at this chart because if we were to run a trend line through the last few decades, what you would see is that we are pretty much right on trend for where spending should be. And that 06 was well out of line, but that where we are is not really out of line. So we're not expecting a big pullback in housing and housing spend, and we expect it will recover to new highs soon. That is my grandfather and grandmother. U.S. is a nation of immigrants. Their parents emigrated to this country. They did what many immigrants do. They started a business. In this case, they started a factory, metal stamping factory. And my grandfather's father, and he and his two brothers built a business that was very successful in the 1920s and 30s and into the 1970s. Today, the US has the largest percentage of immigrants as a percent of the population since the late 1800s. This is from the Pew Research Institute. They do interesting work. It is good for the US, has always been good for the US. Much of the controversy that is swirling around immigration has to do with the massive level of illegal immigration that occurred. The US tolerated under President Obama and during the first Trump term, approximately somewhere between 800 and 900,000 illegal immigrants per year. And by the way, President Trump in his first term actually deported fewer people per month than President Obama did. What got people upset was that the number of immigrants surged to over 3 million per year under the latest administration. And that caused a problem. And so that's why there's this controversy over immigration. Most Americans, in fact, over 70% of Americans support legal immigration. They are just less enthusiastic about illegal immigration. So, in terms of immigrants, whether this will get settled anytime soon, we don't know, but it would be helpful if Congress had some kind of reform that kind of settled this for a while. And the reason immigration is important because of multifamily demand. Immigrants typically rent, they don't buy. Multifamily area has had a huge boom due to a variety of factors that all came together at once. After the housing bust, 2008, 2009, 2010, there were over 3 million families that needed to move back from owning a home into rental housing. That added demand for several years. In addition, you had a whole new generation of workers, the millennials, come into the workforce, and they were in their prime rental years. And they've now moved into their prime home buying years. And we had immigration and illegal immigration, and then we had a huge surge in illegal immigration. On top of which, the Federal Reserve dropped interest rates to zero, which made all the multifamily owners very wealthy over time because the value of their buildings went up even with no improvement in the cash flow. That all came to an end early this decade, and we see this becoming a much more difficult environment for multifamily. Multifamily does have some oversupply that it needs to address because we had a lot of buildings started, many of which the equity investors have been out now, but will be completed. And once those come online, things should return to more normal. But this whole area probably will have a much more difficult path forward than in the past, as interest rates are not going to act as a tailwind, but a headwind. Multifamily starts have collapsed to 50% of their peak level and now are below where they were pre-pandemic. And as a result, should be self-correcting. US auto sales have kind of gone sideways. And that should be good for the US, except two problems. US domestic output of new autos continues to drop relative to the economy, and imports of autos continue to rise. Almost no country in the world allows this to occur. Europe is a producer of surplus autos that it ships to the United States. Japan is a producer of surplus autos it ships to the United States. China is now a producer of surplus autos, which it tried to ship to the US, but is now shipping to the rest of the world. Korea ships significant autos to the US, significantly more than it can consume domestically. And all these countries know that autos are a significant part of the industrial base. And part of the reason that President Trump wants to renegotiate US-Mexico free trade agreement again is because people didn't get the message the first time, and a larger percentage of US autos need to be built here, and a larger percentage of value of those autos needs to be built here so that this does not continue. And as you can see, each cycle, the output of vehicles and parts has declined over time. Okay, let's talk about real asset growth in QE/QT world. I call it as the worm turns. Federal Reserve basically drove interest rates down, which drove valuations way higher than they should be. And you had a stampeding bull. This is like my favorite traffic sign from Spain. And by the way, there really was a cattle crossing ahead, and you had to watch out. Your car wouldn't do well if you ran into one of them. Okay. Here's corporate equities to GDP. This is also known as the Buffett indicator. Very expensive. Here's one of my favorites. This is Shiller. Yes, the same Shiller from Case-Shiller. And as you can see, valuations today under the Case-Shiller Cape are above where they were in 1929 and not too far from the peak in 2000. This is Tobin's Q. And as you can see, they're as expensive as they were back in the 60s. And here is one of my favorites. This chart is care of Jeffries. This is the S&P 500's price to sales, which, as you can see, is well above the peak in 2000 and reflects the massive margins and ROICs that companies today are earning. But what history tells us is that that is unsustainable over time as competition comes in and new ways of doing things supplant the old. Somebody was asking me before the meeting about AI and its impact. And AI is partly why the market is valued where it is. We think AI will transform the economy. But just like the internet, we do not think it will transform the economy the way people expect. We think it will actually be broader and deeper, but different than what today people have built into their futures. And by the way, when valuation is here, 10-year returns on the market are poor, which makes sense, right? If you pay a lot of money for something, it's hard to make money over the long term. You actually want to buy when there's blood in the streets. 2008. And oh, by the way, the other thing we know about the Cape, which is the Shiller PE, is that over time, it always mean reverts. So over a decade, we can expect it to mean revert. And this sort of math example illustrates what will happen over a decade if it mean reverts. Effectively, the return on the market will be zero. You'll collect some dividends. And that's why, by the way, dividends have traditionally made up 50% of the return in the equity markets. And by the way, as we all know, rising capitalization rates impact the value of assets. In this case, this is an example from the Federal Reserve of real estate. But as we all know, this has impacted PE as well. PE valuations have come down, and it's caused problems with the number of funds. That's why we now have extension funds, and they do all kinds of things not to have to realize the lowered valuation on companies that were bought when interest rates were low and they paid high multiples. So, we'll talk a little bit about what is going on with the US, sort of Trump's tariffs or non-tariffs. I guess it depends on the day. Okay. The reason we are where we are is effectively not addressing what this slide illustrates. This slide is an example of the industrial policy followed by China. So this is just some data on ethylene production globally. And what it shows is that China is going from maybe 15% of global production to somewhere north of 30% of global production. This is a problem. If you look at what China has done in other industries, this is how it grabbed 40% of the global flat panel display market. This is how it took 20% of the global agrochemicals market. This is how it is now planning to take 25% of the global semiconductor market, and how it plans to dominate numerous other industries. This is what needs to be addressed. Tariffs won't necessarily solve this. And we'll talk about what might. And the problem is, when we put tariffs on China, all that happens is the production moved to Vietnam, which produces 1 in 4 Samsung cell phones. Or you have other policies such as Malaysia with its 2030 industrial policy. Or you have Indonesia with its resource nationalism. Or what Indonesia just did, which is what China followed for the last 25 years, it basically embargoed Apple iPhones from the country and said, Apple, if you want to sell phones in Indonesia, you have to invest in Indonesia and build stuff in Indonesia. So what did Apple do? It said, okay, we'll build an AirTag plant in Indonesia, and that plant will supply 20% of global supply of AirTags. It's about $1 billion investment. Indonesia initially said, that's fine. Then they said, well, that's not enough. You don't meet our domestic local content regulations for the iPhone. So you need to now build parts for your iPhone in Indonesia if you want to sell iPhones here. And Apple basically said, okay. So that is an issue, especially if you're the United States and you want your stuff, technology built in the United States. The other issue relates to the currency. If I know somebody's putting a tariff on me and currencies float freely, I can just depreciate my currency, and it'll offset any tariff you might impose. Case closed. In 1985, the US dollar had been driven up by the other major economies, the G7. And at that time, Ronald Reagan said no and started intervening in the currency markets to depreciate the dollar. So instead of having an ugly depreciation of the dollar, he sat down with everybody and we had something called the Plaza Accord, and everybody agreed to depreciate the dollar. US dollar is now approaching the same levels as it did in 1985. But the problem is not with the developed market currencies. The problem is with the emerging markets. And this is just an example. This is the India rupee, which is now half its value of 2000, and which has started to depreciate against the US again. If we go back to the 1980s, where we undid the depreciation of the G7, we did allow the emerging economies to continue to depreciate their currencies. In fact, they depreciated their currencies almost 90% back in the 80s. And that was followed by another 50% plus in the 90s, prior to the WTO, which made them hyper competitive from a manufacturing perspective relative to the US and the Western economies. And Japan, which has to compete in Asia and has a big export economy, just dropped the value of the yen 30%. And basically undid a decade of overvaluation of the yen. But that's not good for the US, because to the extent the US competes with Japanese manufacturing, it makes our manufacturing disadvantaged. I'm not quite sure why nobody in Washington pays attention to this, but I can only assume it's deliberate, because if we were to look at this and look at the data, somebody would actually do something about this. And I think ultimately we will, because if countries continue to depreciate their currencies, US has two choices: either to cut off trade with the rest of the world if it wants to maintain its manufacturing base, or to go and intervene in the currency market and start depreciating the dollar. And this does have significant impact on the US. Prior to 2000, US industrial production grew at about 2 to 4% per year. Since 2000, it hasn't grown at all. And industrial production and manufacturing has shrunk and is 5% below where it was in 2006. If the US economy just had manufacturing industrial production grow at 2% for the last 24 years, US GDP would be 6% higher, or $1.75 trillion more. If we compounded at 4%, GDP would be almost $5 trillion higher, and the economy would be 17% bigger. Manufacturing matters. And oh, by the way, you look at this chart, we've gone from about 17, 18% of GDP as manufacturing down to 11. And there's your 6% minimum increase in GDP. US government can have an impact. This was manufacturing investment relative to GDP, and then the Biden administration put in place several acts: the Inflation Reduction Act, the Infrastructure Act, and the Semiconductor or CHIPS Act. And manufacturing rebounded, or at least investment rebounded in manufacturing. In addition, President Trump has been encouraging manufacturing to come back to the US, and a number of companies have already announced that they are going to bring plant back to ensure that they have flexibility to address the market. In other words, they don't want to get shut out of the US, simply put. Now, I like this story because it relates to my story of my grandfather, right? So my grandfather and his father and his two brothers built this business, and they eventually became a very large supplier into the defense industry, and actually the #2 provider of all silver to the department store industry. So I know a little bit about manufacturing. This is another father and son duo, which started a manufacturing plant, and they are now suppliers to, and they started about 4 years ago. They're now major suppliers to NATO, major suppliers to US manufacturers, and a variety of other things in the defense area. They also supply a number of states, etc. So I kind of believe that there is no reason why we can't just have these manufacturing plants here. And in fact, if you just multiplied this one little plant 1,000 times or 5,000 times or 10,000 times, you would solve all the US manufacturing issues, especially given that everything is highly automated, run by ERP systems, and doesn't really require people. So labor costs don't matter. Manufacturing costs are a function of technology and energy costs. And the US is actually one of the lowest cost in terms of energy in the world, and has the largest consumer market to consume its own products. The US actually only produces about 42 to 45% of the goods it consumes. Most other countries produce 80 to 90%. The US used to produce somewhere between 80 and 90% of the goods it consumes if you went back to 2000 prior to the WTO. And that's the growth that the rest of the world has captured from the US. Despite that, I would point out that the US grew almost 3% the last 2 years, while Europe only grew 0.7% each of those years. So the US does have a dynamic economy that allows that. Now, you might think, oh, we're not investing enough in industrial equipment. Well, yeah, but you don't put that much equipment into a plant. You put a lot into IP, which has gone up relative to the economy. You put a lot into technology. And those have displaced industrial equipment in terms of this, and can be seen in capital expenditures relative to GDP. For the US, we're actually close to the median relative to the economy prior to 2000. And there's a couple of ways that we can easily get to where we were in investing before 2000. One is the government actually increases its investment. If the government were just to increase infrastructure spending to where it should, that would add 0.5% here. The government increased defense spending in capital goods to where it should, at least to the Carter levels, that would add another 0.5% to GDP to this ratio. If we had some more incentives in manufacturing, that would add a little bit more. If we required stuff to be built in the US, such as technology goods, that would increase this even more. Many ways to get there, there's not a lot of difficulty returning the US to the type of levels of investment that we had before. I expect that investment in housing is going to continue and increase. And this is all important because US growth could easily be 3 to 4% compound over the next decade. And people ask, how do you get there? How about 2% productivity growth? Manufacturing actually creates over 70% of all productivity growth in the economy. AI is clearly a productivity driver. We're actually investing close to $1 trillion due to AI. $500 billion into AI, another $500 billion into infrastructure needed for AI. So think of it as its own infrastructure act in and of itself. That increased productivity drives faster economic growth. And the population in the US grows 0.5% or so organically, 0.5% to 1%. That gets you to 2.5% to 3% organic growth. And if we have immigration, legal immigration on top of that, you could add another 0.5% to 1% to population growth, and you quickly get to 3 to 4%. That's excluding any of the GDP growth that would happen because we are not importing things, but making them here, which would shrink our trade deficit relative to the economy and increase economic growth even more. So it will be very easy for the US to actually grow at a pretty high compound rate over the next decade. And I think this is the way the US is going to go for national strategic regions, and because typically what the US has done when it has a debt problem, it grows its way out of the problem. So remember, we started this with looking at US debt to GDP, which was at World War II levels, 124 to 126% of GDP. After World War II, we did this, got rid of that debt in two ways. One was we grew nominal GDP at a pretty rapid rate, and we had inflation. And I think it's tried and true mechanism for the US. Here's non-farm business sector labor productivity, which has now recovered to a level well in excess of what it was under the Obama administration. And here's something that can be proven. Economic growth is path dependent, and how a nation allocates capital and labor determines future economic growth. We think that China has significant economic problems. We think that China has issues that are fundamental to the economy. Housing, which used to be 25% of the economy, is probably down to something like 10% of their GDP. Manufacturing is now 35% of their economy, and 20% of their GDP relates to exports. We think that that whole area is going to come under significant pressure. And as a result, their economic growth going forward is going to have lots of issues. We also believe, based on data on the ground, that the economic growth they've been reporting in the last few years is overstated at best and potentially negative in real terms. That's been sort of masked by their massive export push. I always like this quote by Laura D'Andrea Tyson, who was the President Clinton's head of the Council of Economic Advisors, very smart lady. And she said, the composition of our production and trade does influence our economic well-being. Very true. Technology-intensive industries, in particular, make special contributions in the long-term health of the American economy. And America has always been good at innovation. A dollar's worth of shoes may have the same effect on the trade balance as a dollar's worth of computers, but the two do not have the same effect on employment, wages, labor skills, productivity, and research, all major determinants of our economic health, and I would add, our economic growth. And with that, I'll take questions.
Paul, what the dollar is the world's economy. You know, I've heard, read.
It's the reserve currency.
Reserve currency, thank you. I mean, that's not gonna be forever.
Well, okay. So let's talk about some data on the dollar and sort of what's gone on. So the dollar share of global financial transactions has been declining. The dollar share of global trade has been declining over the last decade. Slowly, it is still dominant. Obviously, China's currency has been rising as a share of both global financial transactions and global trade. Because the Chinese, if we're selling goods elsewhere, we want people to pay in the Chinese currency. So they're trying to get away from the dollar as much as possible. Okay, it's the other reason, if you look at China, they have been trying to sell off their dollars and buy gold. And oh, by the way, I'll just make a mention, which I didn't mention during the talk. Gold has hit a record high over the last week or so, almost 2,900. If you guys remember a year ago, I came in and was bullish on gold, and it has done very, very well over the last year. We have an ultimate, well, what we consider a conservative price target of somewhere between $4,000 and $5,000 for gold. But so I'll just mention that, but the dollar has been shrinking as part of the global financial system. And that's just going to be a natural long-term decline unless we start manufacturing a lot more stuff and selling it around the world. Okay, and especially if we correct the overvaluation, it will decline as a percent of everything, right? Just by definition. Okay. Next, back there.
So my issue is that the assumptions you make are very, very good and very, very valid, but they
Okay.
assume the same political structure. And so
What does the political structure have to do with the result?
The results, because I feel that the trends that you illustrate are valid, obviously. But they have been generated under a given political system that today is under very great pressure. And I'm wondering.
Define what you mean by great pressure.
Sorry. So, well, I understand the pressure that we're in is there is a contempt for expertise these days. Our universities aren't quite functioning the way they used to way back then. And we're potentially in, I wouldn't call it a revolutionary cycle, but as sees across the Rubicon, the American economy goes across the Rubicon. And that becomes a danger. Everybody thought 1929 was going to be a fantastic year. Everybody thought the depression was going to end soon. And really what got us out of the depression was World War II, like it or not. So I understand, I hear what you say, but I wonder about the validity for the next 5 to 6 years. Personal opinion as a chemical engineer.
Okay, is there a question? Or is that just a statement?
So I mean, so my question is,
Okay,
how valid are your projections and your predictions based upon that your assumptions may not be correct anymore?
which assumptions are in question? And then I'll
Well, the
answer to
assumptions in
those.
question, I believe, are that the government will continue to do rational things.
Well, the government has not done anything rational for the last decade. Okay, so let's start there under either administration. Okay. At least from a financial perspective, both administrations felt that they could, whether it's the first Trump administration or the Biden administration, they both spent a lot of money and didn't collect taxes. Okay, so that's not rational over the long term. typically what you want to do when the economy is growing is collect taxes and then run a budget deficit countercyclically when we have a recession. So I don't think that there has been any difference between either side of the political aisle when it comes to spending or wanting to raise taxes. Okay. So, I mean, that's just what happened, right? So I'm not quite sure how things are less rational now than Washington's always been somewhat chaotic, at least as far as I can remember. And that's,
Always been chaotic, but I think we've reached a new level of chaos, but no, we'll see, right?
we'll see. Okay.
Oh, can I ask a more direct question?
Yes, you can. If you can start, my question is,
My question is, the last three administrations, and this current administration has a very interesting stance on immigration. And it's proven that its stance with, in particular with respect to H-1B visas, has pushed tech talent north of the border.
Right.
In large quantities. And it's very challenging to me to understand that this administration is going to do anything but continue to do that, despite the fact that some of the billionaires that are advising it are trying to steer it in that direction, because that's not what they promised. And that, based off of your quote around having the spending on tech versus a pair of shoes, is going to have a very dramatic effect on our ability as a nation to capitalize on everything that you've outlined.
well, I think the H-1B visa program is controversial, to say the least. Okay. I don't disagree. We need to bring in talent from overseas, but I also think that they need to reform immigration in a way that if you're bringing talent here, you create a pathway to citizenship so that they become permanent here and not hostage to H-1B visas, right? Because I know, right, and this is one of those things you got to think about. I think it's part of overall immigration reform, right? And I think it's really hard to deal with what you're talking about piecemeal. I don't know what the current administration stance is going to be on H-1Bs. I know what the prior administration was.
Well, I
Okay.
guess even if you think broader than H-1Bs, then.
Right. I do think broader than H-1Bs.
But tech talent in particular from Canada, I know,
Oh.
already very difficult to get in the first place. So.
Well, the other thing is we need,
reform.
but the other thing we need to do is train more people in the US. And that has to do with reform of the education system and some other things and incentives.
So, you gave us kind of a fire hose of information here.
Yeah.
Can you highlight the 1, 2, 3 key issues from the perspective of this audience as investors, and then the perspective as business operators,
Okay.
and if they're
Okay.
different?
Okay. So one, perspective of investors, your cost of capital is going to be higher going forward than it was for the last decade. And it's not going down. Okay. I know that ITR had a thing, right? They're pretty well known. And right, they did this thing and everybody's predicting rates are going to drift down over the next decade. That would be actually contrary to what all the data indicate is going to happen over the next 5 to 8 years. Okay. So one, I would assume the cost of capital isn't going down and probably will go up.
As in like PE ratios or stocks?
Well, I'm talking about interest rates and the cost of equity capital is going to go up, which means the multiples on PE companies will go down. The multiples on real estate cash flow will go down. Okay. So I think that that's just a reality. If your cost of capital is higher, the multiples are lower, right?
We saw that just when interest rates were going up.
Right. Okay. So I think that's going to put pressure on asset prices or the ability of asset prices to appreciate. But the other thing, which is positive from that, is it's going to put a real cost of capital behind spending. So when people spend money on capital investment, it's going to have to really drive ROI, and it's going to get rid of a lot of marginal stuff that was done because you have a low cost of capital. So I think cost of capital is one thing you have to pay attention to. The other thing I think you have to think about is the composition of the US. I think there's going to be a real push by the government to push more manufacturing to be here. You saw this under the Biden administration, you saw this under the first Trump administration, and you're going to see it under the second Trump administration. As the charts indicate, manufacturing to GDP is very low here and can easily go up quite a bit. I think the third thing is the federal government is hard up for money. So we're starting by cutting costs, right? But that's not going to be sufficient to solve the problem, right? So they're going to raise taxes and we're going to have inflation. Okay. So I think you got to keep all of that in the forefront of your mind because there's no other solution. And the other thing I truly believe, the federal government buys over 50% of all healthcare in the country. Ultimately, it's going to use that buying power to squeeze the healthcare system. As a percent of GDP, we spend more on healthcare than any other country and get a worse result if you look statistically. And so I think that ultimately we're going to go down the path of squeezing this whole healthcare system because it's too big. And if you look at the cost of healthcare and how it's ballooned as a percent of the federal budget, the only way we're going to be able to truly spend more money on the things which we need to, which is investing in the country, is by squeezing some of these, quote, entitlements. And then the other thing I believe is we will have, quote, further Social Security reform. For those of us who remember Ronald Reagan, right, Jimmy Carter tried to have reform. It didn't quite work. And then we had a commission under Ronald Reagan. And what they did is they had 5 Democrats and 5 Republicans, and they had the head of the Federal Reserve. And they basically did things. They taxed Social Security for the first time. It was not taxable prior to then. They raised Social Security taxes, and they did a couple of other things. And I think that you're going to end up with another, quote, Social Security Commission that's going to do something similar. We're going to raise taxes, right? Maybe limit base income, right? Right. So they're going to do things here. Okay. So I would expect all of that. Okay.
Well, you mentioned nothing about crypto.
Yeah. I don't think it's economically important to the country. I think it's another speculative asset class. That's how I view it. Yes.
If I heard you correctly, you mentioned that economy was able to resume after wars. First World War, Second World War, it was kind of helping to, kick back the economy. Question, does war in Ukraine help or damage this economy?
The war in Ukraine has actually been very good for the US economy because Congress has appropriated aid for Ukraine, and that aid then comes back and buys US stuff that's gone there. Okay, so the answer is yes.
Thank you.
War is stimulative to any economy. And one of the things we always think about is if China has real economic problems, there's always a solution of war. Next question. Any questions from the Zoom audience?
Yeah, I have a question. Can you hear me?
Yeah, I can hear you fine.
You mentioned earlier that taxes are going to go up whether Congress takes action or not. Can you explain how a scenario like that will happen?
A scenario like that will happen is a US debt to GDP continues to go up. At some point, the bond market has a revolt and drives interest costs way up. and forces Congress to deal with it, much as what happened back in the 1990s under President Clinton, for those of us who remember. At that point, the Congress was forced to deal with things, and basically what did they do? They capped spending for a while, and they allowed the economy to catch up. And actually, in the last year of President Clinton's presidency, we actually had a budget surplus, for those of us who remember. Okay. Any
Question.
Yes.
So, when you started, or near the beginning of the presentation, you were talking about how you expect returns in the stock market to be basically zero over the next 10 years. So that was pretty grim when you said it. But then later in your discussion, you're saying, but if we grow and we increase our manufacturing, it sounds like we could have a much better picture than what you were saying in the beginning.
Don't confuse the economy and the stock market. Paul Samuelson famously said once, the stock market has predicted 9 of the last 5 recessions. Okay, so what I would say is they are 2 different animals. We grew the economy quite well from 1965 to 1980. During that time period, the stock market had a return of 0 in nominal terms, and in real terms shrank significantly. If we go to the period from 2000 to 2013, the stock market had a return of 0. So we do have long periods of time where the stock market produces a 0 nominal return, which means it produces a highly negative real return. And I'm talking price. I've excluded dividends from this, right? So you do get some nominal return from dividends. Okay?
So yes.
That's recent examples.
No, that helps. So if you have a crystal ball with the current administration, do you think they're going to do the right things to grow our economy? We'll now talk about the economy side. Thanks for clearing up the stock market side and separating.
The economy, I think they are going to try. Okay, how successful that will be is unclear. There's not a lot of scope for sort of additional pump priming because of where the budget deficit is. And there's not really scope to cut taxes from here. The quote tax cuts they're talking about are really an extension of the existing tax law, which is set to expire at the end of this year. So they're not really, quote, cutting taxes to new lows. I think they'd like to do that. I think it's going to be really hard given where the starting point is now.
Okay. Thank you. Very, very informative. Thank you very much.
Any other questions from those who are listening via Zoom? One right in front of me. Yes.
What do consumers misunderstand about tariffs, the impact of tariffs?
What do consumers misunderstand? Well, I think the public thinks, if they're not educated, that tariffs can sort of either increase the cost of a good or prevent a good from coming into the country. Neither of which is necessarily true. That's an it depends on many, many factors. Okay.
So if I'm hearing what you said about the stock market, it used to be kind of an adage that over any 10-year period, an investment in a diverse portfolio of stocks will deliver a 10% annual compounded rate of return, including dividends, of course, over any 10-year period that you select.
Well,
as an investment advisors.
okay, well, that is actually a false statement. It can be proven that that is untrue. Okay, so what the statement should be is over any 40 to 50-year time horizon. The stock market compounds at about 8 to 9%, which is what the long-term nominal GDP of the United States has been. Okay? But not 10 years.
Mhm.
And
That's another one.
yes,
On, agriculture.
yes.
China happens to be a really big consumer historically of American corn, soybeans, et
It's
cetera.
now a big consumer of Brazil's.
Yeah, right. So
Okay.
the tariffs that were put in place and just shifted China to buying from Brazil, right? So the US had surplus.
Well, it'll find a new home.
Joe,
There's a lot of places it can go. It just won't go to China.
you mentioned that manufacturing can grow.
Right.
Agriculture can't really. There's like the arable land and can't make more.
Well, but here's the deal. Productivity growth in agriculture has been about 1.5 to 2% per annum compound for the last 50 years. So yield per acre has gone up. Okay.
Haven't government subsidies really kept that agriculture?
Every
Industry.
government subsidizes agriculture around the world. Okay. Oh,
Could you
sorry.
please explain why increased tariffs would not lead to increasing prices on the product? Just as an example, why could it be?
Mm, Simple example, the product just comes from another country. Okay. Manufacturing goes from China to Vietnam. Okay. Another reason, country depreciates its currency to offset the tariff. Okay. It's two ways. Right there. Okay. All right. Thank you very much.
Beacon is a national community of senior-level business leaders committed to sharing, helping, and learning. To find out more, go to beaconforlife.org.